New years, new questions. And the questions I want to answer in this video are related to the Swiss market or the Swiss index. First of all, what is the Swiss market and what is the Swiss index? Second of all, is it truly worth it to invest in the Swiss market? I mean, it's particularly small, but is it actually worth it? And then, what are the options that we have in order to invest in the Swiss index or the Swiss market? We will see them, we will see the advantages, we will see the disadvantages right in this video. Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing or finance in general. And if you love the subject, please consider subscribing. First of all, what is the Swiss index or the Swiss market index or the SMI? It's an index that incorporates the 20 largest companies, stocks in the Swiss market. Very straightforward, 20 largest companies, very similar to the S&P 500 for the US. So very familiar actually. And because it has these 20 largest companies, it manages to cover 70% of the free float stocks in the Swiss market, which is actually very good, and it's truly a good representation of the Swiss market in itself. As many indices, the Swiss market index has the main purpose to represent its group of reference, such as the S&P 500 has the goal to represent the US market, the SMI has the goal to represent the Swiss market, and it does it pretty well, with 70% of representation, 70% of the free float. It is important to understand that it's a price index, meaning it doesn't have dividends incorporated in it. There is a total return version, but it's not the main one that everybody talks about. It's not the original index, such as again the S&P 500. It is market capitalization weighted, meaning it's trend following, meaning as a particular company gains more market capitalization, it's gonna be more represented inside the index. So bigger companies are more represented. This simply means that as a company grows, it grows the share inside the index. Meaning, again, the investor will automatically invest in the companies that are doing well. This is called trend following. As a company increases its prices, it increases its market capitalization, and we increase our share inside the company. This is all trend following, which is actually one of the best trading strategies out there so far that I've seen myself. It's one that really works. It's one that takes a lot of time and takes a lot of patience, because you will have big drawbacks sometimes when the market fails, but in the long run it works and it increases the capital gains, it increases the revenues by a lot. So how is the performance? The performance of the Swiss market index is actually good, it's average, it's in line with many other indices out there. There is no particular reason to say Switzerland as being worse than any other country. It's very, very average. As far as the dividends goes, also good as well, average, in line with many other countries. We are talking about the 2.2% more or less a year, which is good. It's not extraordinary, it's pretty good. For an index, it's good, especially for a steady index like this. What can we expect inside the index? Well, as we could expect, we can find healthcare, we can find consumer goods, and we can find financials. What else Switzerland is good at? Healthcare and financials especially. So we will find banks, we will find insurance companies, we will find healthcare companies such as Novartis, for example, and also consumer goods such as Nestlé, for example. And then banks like Zurich or financial institutions like Zurich and UBS and so on. It is important to understand that because of these industries, we can see the Swiss market index as being built on very heavy third level industries. So we are not talking about farms, we are not talking about secondary markets, we're not talking about secondary jobs, sorry, but we're talking about third jobs. Meaning it's very reliant on also other resources because, well, Novartis needs resources from other countries to build pharmaceuticals. Nestle needs resources to build their products, and those resources are not found in Switzerland because, well, we don't have them. The country is too small, and so we rely heavily on other companies and on other countries. Not necessarily on other companies, because many of these companies do the duty themselves, but on other countries. That's important to understand. Also for financials, I mean, the Swiss market is not as big, so you need other countries, you need other people from other countries to, to take insurances from Swiss companies. You need other people to come here and to put their money in our banks. So we are reliant on other countries, and that's important to understand. So the Swiss market actually is, as we said, in line with other countries, and maybe there is a reason for it. All right. So that's something to keep in mind. So if you invest in the Swiss market, you are investing in the third job sector, in the third level. I don't know how to call it in English, but it's all the administrative and it's all the final products. Maybe not so much for the consumer goods, but certainly for financials and certainly for healthcare. But what about the Swiss market in itself? What about Switzerland in itself? Well, it's a small country. We are 8 million people, and we don't count that much in the big picture. We are count at less than 3.2% in the MSCI World Index, so that's something to keep in mind. But we also have low volatility, looking again at the MSCI ratings. So that's good, but on the other hand, we are small. So that's something important. I mean, when you invest, you want to diversify as much as possible. Here in Switzerland, you are decreasing the diversification, you are increasing the specific risk on a country that really doesn't count that much around the world in investment perspective, of course. So if you invest in Switzerland, you are increasing your risks. You're not decreasing them. Unless you have a super big portfolio and you want to choose your countries specifically. But for example, if you have already an MSCI World, you're pretty much good to go. Unless, again, you have big capitals and you really want to pinpoint your diversification and you want to, lean towards the Swiss market a little bit. But again, you are increasing your specific risk. So how to follow the Swiss index? That's very important. Of course, ETFs. What best friend we could ask a help to than ETFs? We have the iShares SMI exchanged in Swiss francs, which is the best option that I could find, especially because it's exchanged in Swiss francs. So for all the Swiss people out there, if you wish to invest in the Swiss market, that's certainly a good ETF. There are other ETFs quoted in euros, not for the SMI though, I think. I have to revise that, but I'm quite sure that for the SMI, we only have the iShares ETF quoted in Swiss francs. So that's still a great option. iShares is a really good company. BlackRock is a really good company, and so their ETFs are very good as well, and they don't have a big price. We are talking about 0.35%, which is very low for such a small ETF or such a small market, I would say, not much ETF, but yeah. It's a very good ETF and certainly recommended to invest in the Swiss market index. So, who is the Swiss market index for even? Well, the Swiss market index, as we were saying again, it's a very good index, or I should say the Swiss market in itself. It's a very good market to invest for those people that really want to pinpoint their diversification and really want to choose how to invest their money 360 degrees around. It's not much for the classic investor that invests, I don't know, 10,000 francs a year or $10,000 a year. It's certainly not for them. It's for people, I would say it's for people that talk millions. Yeah, at least hundreds of thousands, at least 500,000. Because you first need your entire portfolio to be diversified in order to start investing in these small countries. Because we are putting in line Switzerland as, well, we're putting it in line with, I would say, Latin America, I would say Africa, I would say East Europe. Not that these markets are similar to Switzerland. I'm not saying that. Switzerland is a developed country, it has a developed market, and it has a very fair stability in their index, but it's certainly small. And so it's actually, I don't mind saying it, insignificant in the whole picture. So why are you investing in the Swiss market? What do you care about the Swiss market? And I understand that for Swiss people, I understand that for everybody, you like to invest in your own country. I do understand that. So certainly Swiss market index is certainly for you. But do you actually need to invest in your country when the whole world is open to you? Why would you invest in the Swiss market index if you first didn't invest in the MSCI World, for example? Why would you invest in the S&P 500 if you didn't invest in the MSCI World? You guys, Americans, are the worst at this. I must say it. You always push the United States indices, but you often don't look at the whole picture. You don't often look at the international indices, which are very good. And yeah, they are heavily on the US, but they might not be in the future. And the same thing goes for Switzerland. If you invest in the Swiss market index, you invest in the Swiss market index now and for the next 20 years. If you invest in the MSCI World, you invest in the entire world, which is, well, the only thing that we have to invest in unless we start going to Mars. Well, that's just a consideration. Again, to wrap up, I would say if you are a big investor and you want to pinpoint your diversification, you have a strategic approach to your investments, certainly go for the Swiss market index. You are a small investor, you invest 10,000 francs a year, which is, again, great. It's a lot of money, but it's not that much to start doing such work and investing so much time. Also, another category that might be interested in the Swiss market index is speculators. If you want to speculate and you need to speculate on the Swiss market index because of your analysis, certainly this ETF, the iShares SMI from BlackRock, again, exchanged in Swiss francs, is certainly a good idea. It's a nice ETF. It's exchanged very often and it's easily to find in entire Europe. So no problem for that, you will certainly manage to find it. So this is all I had to say for the Swiss market index. I love the Swiss market, but it's not a good market to invest in, at least for myself. And that's all I had to say. There are other instruments to invest in rather than ETFs. I've analyzed one of them from Zurich. You can see the analysis on my LinkedIn page. I will link my LinkedIn page in the description, but it's not that great. It didn't turn out to be that great. Certainly not better than an ETF. So yeah, this is all I had to say. I hope you liked the video. If you did like the video, please leave it a thumbs up and I will certainly see you guys in the next video. And by the way, 90% of you are not subscribed on this channel. So please subscribe, clicking the red button down below. And I will see you guys in the next video.